Now let's continue with the units of a production method for measuring and recording depreciation on the long-term asset. Units of production method is assigned to unit of output produced by the asset each period. So the depreciable cost is multiplied by percentage use, which is the number of unit produced each period divided by the total estimated useful life. So that percentage is some estimation, but we put this percentage to depreciate to allocate the original cost of the purchased asset every year. So let's go to this exercise. The same example, your company purchased a truck for $31,000 cash and recognized unit of production depreciation based on the information. $31,000 and the estimated useful life, we have the same information like this, but assume the company expects to drive the truck 20,000 miles during the first year, $30,000 miles during the second, and 50,000 miles during. So the total is the 100,000 miles. 100,000 miles. So we will allocate this to 20,000 miles out of 100,000 miles. The total estimated useful total units, and then we apply this percentage into the depreciable cost. So the same procedure. So the book value when the company purchased this truck, $31,000, and then yearly depreciation. The original cost the 31,000 minus the estimated residual value is $1,000. Now times 20,000 miles. So we put the 20,000 miles divided by 100,000 miles. The total estimated the unit total estimate and miles. So 100,000. So the 6,000 is the depreciation expense for the first year. We haven't accumulated anything, so the depreciation expense is the same as accumulated depreciation. And then book value is decreased by this accumulated depreciation on the balance sheet. So 25,000 is the net book value for the first year end. Second year end, also 31,000 minus 1,000 is depreciable cost. We apply the percentage of the usage of this truck. Now the second year, 30,000 miles divided by 100,000 miles, the total useful life, right? So we put this percentage, so 9,000. Then accumulated depreciation. Accumulated depreciation is just we accumulate this depreciation expense of the second year to the accumulated depreciation we have accumulated onto the balance sheet. So 15,000. This 15,000 is a subtract. This is the subtractive. Subtract is $31,000, right? So we got the 16,000 is the net book value based on the usage, based on the unit of production depreciation method. The final year, the same procedure, 31,000 minus 1,000 is depreciable cost, where we put percentage of the usage. So third year, we expect 50,000, right? The 50,000 the drove, so 100,000 is total, so 50%. So $15,000 is the depreciation expense based on the actual use of this asset. And then we accumulate this depreciation into the accumulated depreciation so far. And then the book value should be same as the residual value at the end of the year, $1,000. Good. Okay, we have the same name of account first year as the previous exercise. So the truck we purchased 31, depreciation 6,000, and then 9,000, and then 15,000 third year, right? The cash we purchased. 31, accumulate depreciation should be recorded on the balance sheet, the same amount as the depreciations. Again, this accumulate depreciation on the journal entry is just 1 year accumulate depreciation. So don't be confused by the accumulate depreciation on the balance sheet. On the balance sheet is the accumulate concept, but this accumulate depreciation is only 1 year accumulate depreciation that should be recorded on the balance sheet. Okay, so now let's post this journal entry onto the balance sheet and income statement. Oops, 31,000, and then cash out the exactly following with this journal entry. And then accumulate depreciation of the first year. Where is it? Okay, 6,000 first year, right? So we got the truck net book value is $25,000 exactly. We calculated. Then on the operating expense on the income statement, depreciation expense always minus, right? 6,000. So 6,000 if there's no other transaction assumed. So $6,000 should be recorded on the retained earning. So we balanced out. So the first year, the truck net book value is $25,000. Okay. Then second year, always we put start second year trend the balance sheet creation from the ending balance of the last year for the beginning balance of that year, right? So we have to start from then on. Start from then on. Okay, then. The earning, also 6,000. Okay, then let's put this depreciation 9,000. Depreciation expense $9,000 for the second year, right? Then accumulate depreciation is contra account that reduced asset value. That's why we record on the credit side $9,000. So the accumulate depreciation $15,000. $15,000 is this. And then we got the truck net value is $16,000 as we calculate on the depreciation schedule. Then let's complete this income statement. It should be also now added into the retained earning $9,000. Okay, so we got 35,000 total balance of asset and liability equity balanced out, and then the truck book value, net book value is $16,000 as we calculated like this. Now the last year, the balance sheet and income statement also should be started with this ending balance of the last year as the beginning balance of the current year, always the starting point. Now let's put the depreciation expense of the last year. We have using this asset, the 50% based on the usage, right? Oh, it should be negative. Then income for tax, ignoring tax in this case. So we added this net income into the next. Then we put the accumulate depreciation of the last year, $15,000. So we got only $1,000, the truck book value, which is the same as the service value, this residual value, $1,000 as we expected. Okay, this is how we allocate the cost of this truck, $31,000 based on the unit of production. The depreciation is a little bit more specific, the depreciation method than the stat line method. Stat line method we just allocate throughout the year evenly, the equal amount. But this case, units of production depreciation, we allocate this $31,000 based on the actual use of the asset. okay, based on the driving miles. Okay, see you in the next video clip for the double declining balance method. Bye bye.